Okay, so I asked Steve Waldman what sort of biography he would like, and Steve is very self-deprecating. So, just for fun, I'll share with you his
very accurate.
His description, he said, let's just tell him that I'm an asshole. But I don't think that's accurate. I think he's a very sharp guy, and so I'm looking forward to the talk. He blogs at interfluidity.com. He's had a few interactions with Paul Krugman, has cited him on the New York Times, and I enjoy following him on Twitter. So, cryptoasset valuation for designers, please.
Okay, so you've all heard now my one credential. So when I was talking to Christian about this talk, we were talking about cryptoasset valuation, and I have lots of little opinions about things like cryptoasset valuation and asset valuation in general.
By the way,
yeah.
The questions. So it's tempting to ask questions, but I guess your policy was you generally wanted to save them for the end, unless it's really pressing. Is that right?
Unless it's sort of a clarifying thing. I made too many slides, so I'm going to try to press through them fast, and then hopefully there'll be time for questions. But if there's something, like a short clarification, then that's okay. But I don't want to get into a long conversation because I'll get through like 4 slides. This talk's called Cryptoasset Valuation for Designers because it occurred to me that that's a much more interesting space than just talking about valuation, particularly valuation of existing crypto assets. In a certain sense, this talk is a reaction to the fact that especially Bitcoin is an asset almost designed to be nearly impossible to value accurately. And so this talk is really about how we can design crypto assets that are valuable in the sense that we can value them. So here's some slides. So I think we want to think this is an Ethereum group, which is great because it's the perfect platform for us to think of cryptographic assets as a kind of design space, meaning they don't already exist in the world. We don't have to conform to lots of existing conventions or regulations. We get to make them up. And a lot of us, I think, especially in the Ethereum community and the sort of Web3 distributed app, decentralized, autonomous organization, corporation community, really are thinking of designing cryptographic tokens in the context of some larger application, meaning we want to create incentives for people to participate in some kind of community or application, maybe some kind of enterprise that's a business enterprise, maybe something that's a social enterprise or a political enterprise, or to some kind of social media site or some kind of commerce site where we want to reward people for certain kinds of positive participation. All of those are the kinds of applications in which cryptographic tokens are being talked about in this community, in the Ethereum community, quite a bit. And so a crucial thing about tokens like that is that if we want to have tokens because we want to incentivize certain kinds of participation and behavior, well, the incentives that surround a cryptographic token have to do with people's sense of the value of the tokens. They don't provide any kind of incentive to anybody unless somebody feels like they understand, okay, well, they're worth something to me, and this is why, and this is how much it's worth. And it turns out, I think the Bitcoin experience is a great example of the fact that you have to work a little bit to get a token or a financial asset, something that is allegedly valuable, but it's actually something completely abstract. Cryptographic assets are the most abstract assets we've ever invented. We have to work a little bit to get them to be things that have coherent values, that we can value, right? And so fundamentally, this talk is not so much about thinking about, okay, these assets exist in the world, how do we value them? It's more a matter of thinking about, well, when we construct them, how can we make them valuable in the sense that we are capable of valuing them? And then we can work backwards from that, right? We can look at existing assets and see to what degree we can coherently value them by the same criteria. So the general approach I'm going to adopt is sort of inspired by sculpture in the sense of we're going to think of the stone as being an unconstrained value space, right? So fundamentally, if I say there's a token in the universe, how much is it worth? Your answer should be, what the fuck? I have no idea. It could be worth anything. It could be worth anything from 0 to infinity, because what is this token? Or actually, if we it has a value space even larger than that. We'll look at that in a little bit. But so we start out in a game theoretic way and an information theoretic way with no idea of what the value of the token is. It's a blank slate or a stone, to use the sculpture analogy. And what we want to do is get some kind of a chisel. We want to find some way to constrain the potential values associated with the asset so that we can say, okay, we know what this thing is worth. So that's really what we're going to be up to. So I'm going to emphasize a lot when we talk about this sort of valuation space that it's a game theoretic space. And mostly that's a way of saying that it's really complicated. Lots of times when people talk about game theory and Nash equilibria, you hear people make claims that something is a Nash equilibrium, so something will happen, right? We can predict what's going to happen. But actually, the core result of game theory is not that, we can analyze games and predict how they'll go. The core result of game theory is that the vast majority of games are entirely unpredictable. There are usually multiple, in some contexts infinite, in the context we're interested in, infinite potential Nash equilibria, all of which are a priori possible. And we don't have any good understanding about why, when there are multiple equilibria, one works for a while and then people switch over to another. There are various kinds of drifts. People study that. This is a very chaotic world. And that's the world that we're in before we introduce constraints. Yeah. Yeah. Oh, we're going to do it. So that's a good question. It's not a stupid question. It's a very good question. So there will be sort of a little game theory review embedded in this talk, so hopefully it will make a little bit more sense. Okay, but we're going to talk, before we do that, about something very simple. So the idea is we start out, they're going to be assets. We're going to create assets. We start out in this terrible situation. When we create an asset, we have no idea what it's going to be worth. It could be worth anything. But we want it to have certain kinds of values to provide incentives for the games that we want people to play, for the distributed applications, the organizations, the firms, whatever it is. We need these things to have values that provide appropriate incentives. So we need to be able to define or constrain the value. We don't want them to be just like Bitcoin, where one day it's worth $1,000 and the next day it's worth $12 and the next day for no particular obvious reason. We want there to be coherent incentives. So we're going to think about ways to constrain the space. So the first thing that we're going to use is just a really coarse-grained kind of chisel, right? If we were a sculptor and we had a stone, one thing we could do is we could say the stone is too big, and we could just start carving it away at it to make the space smaller, to give it a kind of form. And there's a very simple way to give form to a financial asset, and cryptographic assets are financial assets, is that we can simply constrain the price, the value of the asset, within a floor and a ceiling by offering an option to redeem and an option to force issuance. Right? So we start out with this, here's this token, we have no idea what it's worth. It could be worth 0, it could be worth $1 million, it could be worth anything. But if I tell you, hey, you know what? I'll redeem it from you for $10. If you give it to me, I'll give you $10. And if that claim is credible, that's an important caveat. If you believe that claim that I can meet any redemption request for the asset, then all of a sudden we've cut the space in half. It's no longer worth any value from 0, or we'll see even less than 0, to infinity. $10 is the floor. Since I'm willing to give you $10 for it, it's got to be worth at least $10, right? You can give it to me and get $10 anytime, right? Equivalently, if you, as someone out there, can get one always, say for $50, so if I also offer you the option to force me to issue the asset, I stand willing to sell you the asset for $50, then it can never be worth more than $50, right? Because why on earth would anybody pay anybody else $60 for the asset when they can just pay me $50 and I promise to issue one for $50, right? So redemption and issuance is our most basic, and we'll see it's fundamentally the basis of all of our other tools for taking this blank slate, this blank stone, this formless thing that we don't know what its price, what its value possibly is, and giving it a shape that's coherent, right? So we start out, here's an asset, you have no idea what it's worth. As soon as I offer an option to redeem and an option to force issuance, we've bound it within a range. Now within that range, within that constrained price space area there, that fuzzy line represents there's still an area in which we have no idea what its behavior is like. We're still in the chaotic game theory land. We don't know what's going to happen in there. But we've at least bound it to within a range, and we'll see if we want a closer binding. We can do that rather trivially. So this next slide is just an aside. My slides are very dense. I'm not going to be able to go through them in sufficient detail. You can read them if you can, but they'll be made available to you after the talk, so don't feel like you have to keep up too much. So far, in my previous slide, I showed them the prices starting at 0 and going to infinity. An important thing to know, especially in an environment like Ethereum, is that we're talking about cryptographic assets, and ordinarily assets are distinguished from liabilities by having values bound at 0 on the lower side. But cryptographic instruments, like financial instruments, can also take on negative values, right? We actually have a full space from minus infinity to positive infinity potentially to work with, right? If you want to know a financial instrument that has negative value, open up your credit card statement, right? If you have attached to you by some bureaucratic legal infrastructure a liability, and if you want to get rid of that token, that instrument, you have to pay to get rid of it, right? So some things, we talk about an asset, what's it worth, how much do I have to pay to buy it? If it has a negative value, you have to pay to get rid of it. And in Ethereum, you can create such assets as long as you have applications in which people put funds in escrow to some degree. So you can't quite go to negative infinity, but to whatever degree people have assets on the blockchain that can be a kind of escrow, you can write applications where people can be attached to liabilities, to negative value tokens that could deduct funds from that escrow if they don't find a way to get rid of it. So we have a very large space, conceptually from minus infinity to plus infinity. Okay, so now we're going to take the tools that we've talked about right now so far are really, really basic, but we can make something pretty cool with it, right? So, and this is a cryptocurrency community. Lots of people in the cryptocurrency community have at some point in their lives been interested in gold. If you've ever traded gold as not particularly professional speculator, probably the way that you got your exposure was by virtue of an ETF, like the GLD ETF, that you can trade on the stock market, and it follows the return of gold, right? Well, ETFs are, they're this innovation. They only came to really exist in the 2000s, exchange-traded funds. And their main purpose is to be a token you can buy and sell on a stock market that's supposed to track the price of some commodity, of some portfolio of commodities or stocks or whatever. And how do they work? How do they make a token, like an ETF, where the value of the token is always the price of gold? Well, the answer to that, we've already done it. They just set a floor by offering an option to redeem right below the price of gold. And then they stand ready to issue new tokens for just above the price of gold. And so they can make a range epsilon small surrounding the price of gold. And the ETF's value is always within that range, right? So they can effectively, just by bringing the floor up and the ceiling down, they can effectively make it a point range, something close to a point, that tracks the price of gold. Every day, they just change the range to track the price of gold. Now, in fact, this whole thing at the bottom is a long caveat. For gold ETFs, for example, there's a hitch, because the option to redeem is something that's easy to talk about but hard to live up to, right? If I tell you hey, I'm going to issue an asset and I promise to give you $10 for it no matter what, anytime, that puts a floor under the value as long as I'm good for it. But as Christian reported to you, I'm an asshole. I'm probably not good for it, right? So if you want to make an ETF that's going to be credible, you've also got to find a way to make your promise of redeemability credible. And the way that a gold ETF makes its promise of redeemability credible is when people buy the tokens in the first place, force the issuance of the tokens, the money that they supply to the ETF is used to purchase gold, which is stored in a vault somewhere. And then when somebody wants to redeem, there's always gold available to redeem, right? Because every issued token turned into a purchase of gold, and every redemption has a value of the same amount of gold as its price. So theoretically, they can always redeem, but there's a problem. It costs something to store gold, right? So actually, the price of a gold tracking ETF doesn't actually track the price of gold. It tracks the return of gold less the cost of storage and an administration fee as well. So that's a hitch that makes my story a little bit less simple than it is. But conceptually speaking, if we want to track an asset, we can just put a floor below the price, a ceiling above it with a redemption option and an issuance option. And we have to do whatever we have to do to make the redemption option credible. In the cryptographic world, there are lots of assets that have no storage costs. And a large reason for a platform like Ethereum is to get rid of all the administrative costs. Right? So in an Ethereum world where it's effectively free to administer storage of cryptographic assets, and there's no storage cost, so it's free to administer, free to store, you could literally make an ETF, say, to track the price of a portfolio of 6 different altcoins. That would be a thing you could make. And the price would track it perfectly over time. You wouldn't have this drift apart that the GLD ETF has in order to deal with storage costs. Okay. So when we talk about, to the degree that there's a transaction cost in order to issue or to redeem, that's going to create a little range, right, around the point value price, the transaction cost range, right? We can only bind the value within a range defined by a round trip of transaction costs. We can't do anything about that. What's that? Without a transaction cost? I think that gets pretty complicated, right? So the transaction costs of Bitcoin are often hidden from the people who are transacting for now. In the future, that's likely to change. That's going to be, I'm going to say, beyond the scope of this talk. Okay. So our next thing, I really want to emphasize the game theory stuff because I'm really much less interested in the cryptographic tokens themselves than I am in the institutions that people are going to make with cryptographic tokens. And I want to do a little example of game theory to show how just the tools that we've talked about so far, which are really simple, actually have been incredibly consequential in the real traditional financial system. Right? The tools that we have described so far were used to revolutionize mainstream finance in the early part of the 20th century in the United States. And they did it by intuition. They didn't know about Nash equilibria when they did it. But we can explain why it works to the degree that it does work using a little bit of game theory. So we're going to pull back, and as promised, we're going to do a little review of what a Nash equilibrium is. So a Nash equilibrium is one of the coolest things you'll ever learn about if you haven't learned about them. It sort of really helps you think about the social world, I think, if you think about Nash equilibria. So formally, a Nash equilibrium is a circumstance in which there are a bunch of people, a bunch of agents, and they're playing some kind of game where they have their own goals, and different kinds of strategies offer different kinds of payoffs to them individually. But those payoffs that they receive are going to depend upon what other people do, right? If we're playing some kind of game, if we're collaborating, if we're competing, my outcomes depend upon what you do, right? And a Nash equilibrium is just a circumstance where I'm doing the best thing I can possibly do for me given what all the rest of you are doing, and all of the rest of you are also doing the best things that you can possibly do for you given what all the rest of us are doing, and none of us will ever change our mind given what other people are doing, where all of our choices are consistent in the sense of I'm doing what's best for me, you're doing what's best for you, and even if I know what you're doing, I don't want to change my mind. So we'll see that in the traditional example. I like to describe a Nash equilibrium as a kind of social habit because it's something that arises often arbitrarily. Often there are many possible Nash equilibria that could arise. It's hard to know which one is going to come up. But once one does occur, they sometimes, not always, we'll see, depends, but sometimes they can be pretty stable, so they form a kind of habit. So you can describe customs and conventions as Nash equilibria. Why do we drive on the left side of the road and people in Britain drive on the right side of the road? Well, that's a coordination Nash equilibrium, kind of social habit, but it sticks. Okay, so the canonical example of a Nash equilibrium game is called the prisoner's dilemma because this is a crypto-ish thing. I've adopted the Alice and Bob convention. That's not usually a game theory thing. So prisoner's dilemma. We got Alice and Bob, and they are naughty, naughty people. Alice and Bob. They do something bad, and the very nice Officer Friendly is trying to protect us from Alice and Bob. And he catches them, and he wants to be able to punish them pretty much. But in order to do that, he doesn't have enough evidence. He's got to get at least one of them to confess. So he offers them this game. They know, Alice and Bob know that if neither of them confess, they're going to get slapped on the wrist. So they're going to suffer a payoff of -1, a punishment of 1. But if one of them confesses and the other doesn't, the one who confesses is going to get off scot-free. And the one who doesn't confess is going to have the book thrown at him or her, right? So a -4, nasty, nasty payoff. If they both confess, it's not going to be quite as bad as just being only one person confesses, but it's going to be lots worse than both keeping quiet, right? So ideally, you'd look at this and you'd say, look, Alice and Bob, they're going to look at this arrangement and they're going to both keep quiet. But the thing about it is, Officer Friendly is going to ask them each individually what they want to do, and they're going to be selfish, and in this version of the game, they're never going to see each other again, right? They just collaborated on their dastardly act just once. They don't actually like each other or know each other or care about each other. They're selfish. They're homo economicus. They're just after their own welfare. So you still look and you say, well, the best thing for them to do is to just both keep quiet. But actually, let's take a look at what Alice would do. So this is Alice's thinking. She says, okay, now suppose Bob, the column's at the top, suppose Bob keeps quiet. Do I keep quiet or do I confess? Which is best for me? And we've highlighted in blue which is best for Alice, right? Alice says, look, if Bob keeps quiet, if I keep quiet too, I have to go to jail for a month. But if I confess, I'm off scot-free. So if Bob's going to keep quiet, I'm going to confess. That'd be awesome. I'd get off. But then she says, but Bob might not keep quiet. What if Bob confesses? Well, she says, well, if Bob confesses and I keep quiet, then I'm really screwed. I'm in jail for 4 months or years or whatever it is. -4, that really sucks. So if Bob confesses, then I definitely better confess. Right? So whatever Bob does, my best bet is to confess, says Alice. Of course, Bob is hanging out in his interview room, being made the same offer, and he has the same line of reasoning. He says, look, if Alice keeps quiet, I'm going to go to the red box. 0 is much better than -1. Getting off is much better than having to go to jail. And obviously, if Alice confesses, I don't want to be stuck with a -4, with Alice confessing and me being screwed. If Alice confesses, I want to confess too. So whatever Alice does, I want to confess. So the only strategy that is consistent between both of the players, where each player will be adopting his or her best strategy, given that the other person is also adopting their best strategy, is they both confess, they both rat. Right? So this is a prisoner's dilemma. It's been studied for gazillions of years because it's such a simple story, it's such a simple game, and it's so obvious what they ought to do. By my golly, why don't they just shut up? Right? It's just ridiculous. But this is what they do, what economically rational people do, and you can set up experimental settings where if you set up the game, right enough so that people don't have any empathy for one another, they'll end up in that box. They will both confess because it is the rational thing to do. It is unusually a unique Nash equilibrium. It's the only solution to this problem. So that's a prisoner's dilemma. We'll come back to a prisoner's dilemma. I want to show you a game that is less widely discussed, but in some sense I think more general and more important. And that game is called a stag hunt. Should I keep my mouth closer to the mic or something, or further? Oh, okay. Okay, so this is a stag hunt. And a stag hunt, it's again a game where Alice and Bob have to make choices about what to do given what the other people are doing. And the story of a stag hunt is basically there's an animal out there and we would like to eat it. But one of us alone is not able to overpower the animal, right? We have to coordinate if we actually want to eat the animal, if we want to hunt. But we're also, lazy people. So, if we're not going to succeed, we'd prefer to just chill out and not do anything at all. But if we are going to succeed, it would be awesome to go and hunt. So the payoffs are, look, if we both agree and we coordinate and we hunt, we're going to eat and we're going to get, 3 pounds of yummy stag. But if one of us hunts and the other one doesn't, one of us is just going to be as well off as we were because we're just hanging out, we're just chilling. But the other one's going to lose a lot of time and energy in a futile hunt for a stag that will never be caught, right? So the person who hunts while the other one chills faces a payoff of -2, whereas the person who chills faces a payoff of 0. And of course, if we both just chill, nothing happens. We have a payoff of 0. Right. So what's the Nash equilibrium in this game? We go through the same exercise. Alice thinks about it. She's like, okay, look, suppose Bob hunts, then my best bet is hunt because it's -2 versus 3 for me. I think I have the numbers wrong, but let's just let it be. If Bob hunts, Alice wants to hunt. Because actually Alice, if she doesn't hunt, if Alice chooses to chill, oh no, I'm right with the numbers. If Alice chooses to chill, then she gets 0. But if Alice hunts while Bob hunts, she gets 3. But then she says to herself, but what if Bob chills? Well, if Bob chills, if she hunts, she gets -2. But if she chills, she gets 0. So if Bob chills, she wants to chill, right? So if Bob's going to hunt, she wants to hunt. And if Bob's going to chill, she wants to chill. And Bob goes through the same exercise and makes the same choices, faces exactly the same choices. And so the Nash equilibrium here is equilibria. Right? So this is a multiple equilibrium game, right? Where from an economic perspective, it's really not clear which of these two things is going to happen. Right? Either if they both decide to chill, they're both doing the best thing that they can do given what the other person's doing. If they both decide to hunt, they're both doing the best thing they can do given what the other person's doing. They're not going to end up with one chilling and one hunting because that's a case where somebody could improve their own welfare unilaterally. So they will. But we can't really predict, are they going to both chill, in which case it's going to suck? Or are they going to both hunt, in which case they'll all be better off, right? There's a good equilibrium in this game and a bad equilibrium in this game. And either one can happen, and we don't have good information about why one would happen and not the other. So this sounds very abstract about stag hunts, but there's an example in finance that should be familiar to people that is very precisely a stag hunt, right? So this is stabilizing a fractional reserve bank. That, yeah, Tom?
Quick question. If a game theory considers a loss aversion versus extra payoff, negative versus positive, is that in consideration or not?
So no, not in the way that I've set it up right now, right? Whatever people's utility functions are, right? So there could be a utility function where a loss of, something that I already had would hurt my utility less than an equivalent gain would improve it. But I've already gone through that, and the numbers that I'm putting up here are presumed to be my payoffs in utility, what drives my behavior, right? So that's just sort of by construction. The numbers that I'm putting here are what order my behavior. Okay, so in the fractional reserve bank game, we have a situation where basically $1 in the bank is worth a little bit more than $1 in my pocket. $1 in my pocket, I have to take care of its safety. It's a little bit harder to spend. It's a little bit less liquid. So all things equal, I'd prefer to have $1 in my bank than $1 in my pocket, just a little bit. But the bank, I know, doesn't actually keep all of the money that we put in its care on hand. So I also know that even though $1 in the bank's a little bit better than $1 in my pocket, if other people start taking money out of the bank, I want to take money out of the bank too, right? And that becomes what's known as a bank run. So if we analyze this game, and this was famously done by Diamond and Dybvig, I think the 70s, it becomes a stag hunt game, precisely the game we looked at before. So we're imagining a bank here that only has 2 people. That's for simplicity, right? A lot of this game theory I'm talking about is sort of a lie. Most of the games we're interested in aren't 2-person games, but 2-person games are easy to talk about in a talk and put in a grid. So you have to imagine extending it to multiple people making analogous decisions. But here we have a bank with 2 people in it. The bank, each of the 2 people have $1 to make it easy. So Alice might put $1 in the bank and Bob might put $1 in the bank, but they both know that the bank's going to lend out half of the money that gets put in the bank. And they both know that if all of a sudden they both want to take their money out, they're going to get screwed, right? Because the bank isn't going to be able to, the bank's going to lend the money off to someone else, and if they have to meet an immediate redemption request for all the money, they're going to have to make a fire sale of their investments, and they're only going to get half of their money back, right? So if there's a bank run, if everybody leaves, everybody's screwed, everybody gets half. If only one of them runs and the other one doesn't, it's the same thing. The bank has to make a fire sale. It doesn't have the money, so it has to sell the investments it's made for half their value. So it's got $2 in the bank, $2 invested. It's got to sell it for half. So only one person can get paid out. So if one person runs while the other one doesn't, they're cool. The bank can meet that redemption request, but the other person gets screwed, right? The last one, this is a situation with a traditional bank. When there's a run, the first person who runs gets paid. The last person who runs doesn't. But if they both stay in the bank, they get the benefits of liquidity and security. Everything is cool. There's no fire sale. The bank doesn't sell their assets for half of what they're worth. And everybody can be paid and happy indefinitely, right? And so again, we end up, if we do the same exercise, here's Alice thinking, well, do I hold in the bank? She says, okay, well, if Bob holds in the bank, I want to hold in the bank. If Bob runs, well, then I definitely want to run because I'm going to get stuck with 0. And at least I'll get half my money back if we both run, right? So Alice says, okay, well, if Bob holds, I want to hold. If Bob runs, I want to run. Bob says the same thing. If Alice holds, I want to hold. If Alice runs, well, then I want to run too. So it's a stag hunt. We have exactly the same 2 equilibria. We don't know what's going to happen, right? And so the classic story of banking is that even a bank that seems to be in good shape, things are going well, everybody's in this equilibrium, the bank's fine, but it has, lent out most of its money to long-term investments. It's a wonderful life, right? That story. If everybody came and asked for the money back, bad things would happen. All of a sudden there's a rumor, right, that coordinates people's behavior. Suddenly everybody thinks everybody else is going to run. So even if the bank is perfectly solvent, they all say, look, my best bet, if everybody else is going to run, I should run first because the first person gets paid. And we shift into this equilibrium, right? And so the history of banking is full of bank runs, situations where arguably a bank would have been able to survive indefinitely without causing losses to any of its clients. It was a solvent bank in the lingo. But because there was some rumor, or as Simon Dybvig put it, a sunspot, something happened that coordinated a change from the good equilibrium to the bad equilibrium, everybody runs. Right? Well, what can we do about this? We already have the tool that we need to solve this problem. All we have to do is constrain the value of this token, which is a bank deposit. Right? So all we do is we somehow create a credible guarantee that no matter what, a bank deposit can be redeemed for $1, right? And in actual history, banks have always tried to make that guarantee that they would always be able to redeem your deposits for currency, but the bank's guarantee alone is not always fully credible. In fact, it's that lack of credibility that causes the shift into a run. But if we have the government, we invented the Federal Reserve and FDIC, they collaborate to issue a guarantee, a credible guarantee of redeemability, that puts a floor under the asset. So all of a sudden, $1 in the bank is under no circumstance worth less than $1, right? So if Alice runs while Bob holds, then all that happens is Alice gets her $1 back, but Bob is still cool, still has his $1 in the bank, because the federal government guarantees that $1. So Bob can leave his money in the bank and get in the conveniences of it and not worry about what happens with a run, because the federal government will lend the bank the money to make Alice whole while Bob keeps his money in the bank. Same thing for Alice. Even if they both run, well, then the bank will give them both their $2. They'll be a little bit worse off than keeping the money in the bank because they don't have the liquidity benefits and the security benefits of the bank, but they both get their $1 back. No matter what, there's a floor under the price of the asset. Right? Well, by putting a floor under the price of the asset, if we go through the exercise, okay, so we say Alice asks the question, okay, so I'm Alice, what do I do if Bob holds money in the bank? Well, then I hold in the bank because 1.02 is better than 1. If Bob runs, I still hold my money in the bank because that liquidity and security benefit is a little bit better. Bob makes the same set of decisions. The unique Nash equilibrium is now the, quote, good equilibrium. Everybody keeps their money in the bank. Right? And we saw this happen during the financial crisis in 2008. We had lots and lots of problems. The banks were actually literally insolvent by most reasonable understandings of what insolvency is. And yet there was a value of 1 placed under the valuation of $1's worth of deposits in any U.S. regulated bank. So nobody ran. There were no this wonderful life things. There were no great deposit drawdowns from traditional FDIC guaranteed banks. Everybody stayed in the banks, right? This story works perfectly well. It works really well. And the only tool that we needed was the tool that we've described so far to be able to constrain the value of a financial asset by putting in a guarantee of redemption and making it credible.
That's also a subset of the population, correct? Because the FDIC only guarantees up to...
Well, so FDIC only guarantees at the beginning of the crisis up to 150K, later in the crisis up to 250K, except for certain kinds of bank accounts, unlimited, if they weren't interest-bearing accounts. Institutionally speaking, there's a hole in this promise of redemption for people who have more than a certain amount of money in the bank. In practice, that hole doesn't exist. Whenever that hole is threatened to be breached, for the most part, that's a lie, because during the 2008 crisis, there were people with money not sufficiently well arranged in banks who did lose some deposits. But the U.S. deposit guarantee system is set up such that if you are remotely savvy, you can buy products like CDARSs, which will just take your money and spread it out into accounts beneath the FDIC guarantee. So yes, there is a little bit of a hole in that arrangement, but it's really in practice a hole that doesn't affect Americans very much. There were issues for people who had funds in, say, Citibank internationally, who were in more serious jeopardy of losing funds if Citibank, but the U.S. government didn't let any creditors of Citibank lose $1, right? The only people who actually didn't get a redemption guarantee honored in the U.S. crisis were people who had deposits in small banks at larger than the expanded deposit guarantee in interest-bearing accounts. So there were a few, but a very small fraction. Okay, so this is just the picture that we saw. This is the same as the gold ETF. One thing people don't really think very much about banks is that traditionally banks were like ETFs that didn't work very well, right? A bank deposit is just a token, right, like a crypto asset issued by a bank. It's just a token. And traditionally those tokens weren't worth $1, right? So you would put $1 in the bank and you might get a banknote from the bank, and then you'd go to spend the banknote and a merchant would only accept it for 95 cents because the merchant was afraid that the bank might not be good for it, right? This set of arrangements, like the ETF, where we put a redemption floor just beneath the $1 parity value of $1, was necessary for making the national banking system that we have now, where you, as someone being paid by somebody, literally don't care whose deposits you're being paid in, right? Prior to this set of institutional changes in the early 20th century, there was not parity. $1 in one bank did not have parity with $1 from another bank, did not have parity with $1 from the federal government. In order to obtain parity, we used a redemption guarantee to peg every bank's dollar at the same value of $1 of U.S. currency. So with a redemption guarantee and a issuance ceiling, you can peg. It's all that you need. Okay, so that's cool. We like that, but it's also easy. Okay, so now we know if we want to track an asset, we know how to do it. If there aren't storage costs, or if we have Uncle Sam to provide a credible backstop guarantee, even without storage, right? That's another thing. The banks aren't like the gold ETF. You don't have to watch the value of your dollar drift down because of storage costs. That's because the government provides the guarantee and lets them invest the funds in positive value things, so they're net negative storage costs for banks. So rather than things drifting up or down, they just earn a profit from it. But pegging is easy. The hard part is to know, well, what happens if we have an asset that's not pegged, right? Most of the cryptographic assets we might be interested in making are assets whose value we want to vary with something and not just one-on-one exactly following some other asset. That's a relatively boring use case. We want to make some kind of social media thing, and we want maybe for, communities that collaborate well, they're going to have their own currency, and the quality of collaboration is going to make the value of the currency improve somehow, right? We want our currency to actually fluctuate with things internal to our application that are going to have some kind of a value. We're not going to just be pegging some external thing. So we have to figure out, when we have a space in which things can vary, how can we get out of the nihilism we started with, the nihilism that Bitcoin largely lives in, where, okay, so it's not pegged to anything, so we just don't know anything. It's free to float, and it is $1,000 one day and 50 cents the next, and who knows what, right? Well, it's really hard. This fuzzy line that's unpredictable, this is my favorite slide in the whole thing. Oh, wait. It's supposed to move, but I don't know how to make it move. But anyway, this is from Fantastic Planet, if you've ever seen that movie. You haven't, you should see it. It's a 1970s science fiction animated movie. It is the best. These people, they're all supposed to be dancing, but in this play mode, I don't know how to actually make it dance. So they dance around. But Fantastic Planet is just a very weird place, and the space between those green lines is a very weird space, right? Just naturally, very bizarre things happen. So bizarre things, it's because the game of buying and selling an asset, what happens on a stock market every second and millisecond of the day. Repeated purchasing and selling of assets is a repeated game. Repeated games in game theory, the main result about repeated games is sort of an anti-result, that there's a large space of possible outcomes and we usually can't predict what's going to happen within a pretty large range. If you look at what happens on a microstructure level inside of a stock market, you'll see that prices often stay very near a price for a while, and then for no particular reason they jump discontinuously to a little bit of a different price and stay there and jump discontinuously again. And there are microstructure reasons for why that happens. But one way of thinking about it is the people playing those games find little Nash equilibria, and then something happens, a random purchase from somebody far away that disturbs that equilibrium, and then they settle into a new one, and then they settle into a new one. Sometimes they find more complicated games like Greater Fool, right? Greater Fool is the game that's famously responsible for bubbles, a tech bubble. People like to talk about Greater Fool. Well, I know Webvan isn't really worth $1 million a share, but I think I can buy it and sell it to some other asshole for $2 million a share a week from now. It turns out Greater Fool is a pretty good game, right? It's a pretty good game because you know it's a game that at some point in the indefinite future, you know, is probably going to die. But if the probability of that happening soon is sufficiently low, really if it's Pareto, so that at any given point in time where it hasn't happened, the probability of it happening soon is equally far in advance. At any given time, it's a pretty good game to play. And so lots of people, it's perfectly reasonable to play a Greater Fool game for a while. And lots of people are winners, just people who happen to be playing it at the last wrong round end up being losers, right? So Greater Fool is a game theory, Nash equilibrium kind of game. It's a perfectly reasonable game to play in an indefinite repeated game setting. Indefinite's not the same as infinite. Indefinite means you just don't know when it's going to end. It doesn't mean it's going to go forever. And there's a sufficiently low probability that it's going to end looking forward at any given point in time. So Greater Fool games happen. That's fantastic fun. We just don't know what's going to happen, and lots of pathological things can happen, right? So this is, I'm going to do a little example to show you how this works in the simple case in Prisoner's Dilemma. It's the same game that we did before, but we're going to see that if we let the game be repeated, there are strategies that make any of the four possible outcomes reasonably contributory to a Nash equilibrium. Right? And so the strategy that we're going to think about is a very simple strategy called the Grimm trigger strategy. It's how people typically prove that there are lots of potential Nash equilibria out there. And it's basically like, I'm going to adopt a strategy. We're going to talk a little bit beforehand. We were always allowed to talk beforehand, but what we couldn't do when we were in the first Prisoner's Dilemma is we had no way of enforcing. Like, I could promise to you that I would not defect. I would never tell on you. But then I could go ahead and defect, and there's no consequence for me afterwards, right? This was a one-time thing, right? Now it's not a one-time thing anymore. We can talk beforehand. We still have no means of enforcing anything other than in our own future behavior. But now, because we're going to interact over and over again, if we agree on a plan in advance and then somebody doesn't hew to that plan, we have a means of punishing them, right? And so the means of punishing them, it's called the minimax strategy, is we become vicious and spiteful. And we do whatever it's going to take to make their best possible outcome the worst outcome we can do, right? We're going to minimize their maximum outcome. We're going to make life bad for them. So in a Prisoner's Dilemma game, it's pretty simple what we're going to do, right? We might want to agree that what we're going to do is we're always going to shut up, we're always going to keep quiet, and we enforce that by adopting the strategy that, hey, if we agree that we're always going to shut up, we're always going to keep quiet, and you violate that once, forevermore I'm going to confess, right? So if we come to that agreement, there's no reason why you would ever not keep quiet, right? Because sure, I keep quiet and you confess, and you're much better off in the first round, right? You get off and I suffer -4. But then for the indefinite future, you're stuck in this -3 quadrant because I'm always going to confess thenceforth to make your life miserable. So as long as you value your future, right, as long as your discount rate is not 0, you care about your future. It's got to be a sufficiently high discount rate. You have to care about your future. But as long as you care about your future, you're going to be better off keeping quiet because you know I'm going to punish you by making the worst possible outcome if you deviate. And it works the same both ways, and so it becomes a Nash equilibrium. It's mutually assured destruction, another way of describing it. It turns out, though, I can make a Nash equilibrium out of any of these boxes. I can say, okay, we're all going to shut up. We're always going to shut up, and whoever deviates, we're going to stick you in the bad box. Then we'll do that forever. I can also say, for example, and it's only example, there are probably lots and lots of strategies you could do, but I can say, look, we're going to alternate, right? So I'm going to confess this time, right? And you're going to keep quiet. And then you're going to confess the next time, and I'm going to keep quiet, and so on. And then if anybody deviates, I'm always going to confess. That's the same thing. The expected cost, if we oscillate, is -2. Confessing, us both confessing is worse, -3. So we never have an incentive. If we start out with that agreement, we're going to oscillate confessions. We never have an incentive to deviate. Right? So we're always going to do the right thing. If we start out by agreeing, hey, we're always going to defect, no matter what, we're going to defect, that traditional Nash equilibrium is also stable. So they're all stable. The good one, the bad one, the oscillate between the half and half ones are all potential Nash equilibria, right? Anything can happen. There's no way to know in advance of actually playing the game what people are going to do in the repeated game setup. Now, in this prisoner's dilemma, if you imagine people actually talking to each other, you're like, okay, they're going to pick box 1. But the idea of this is that oftentimes people have to, in a more tacit way, work out their collaboration. And they might work out the oscillatory collaboration. They might work out the always keep quiet collaboration, or they might not figure out a way to work anything out and end up in the shitty box they started in. We can't tell which of these things they will evolve to because they are all equilibria. Once they get there, they won't deviate. They're doing the best thing they can do given what they know the other person's going to do. Okay, so that's all this. We've seen that any equilibrium can be, lots and lots of things become Nash equilibrium in repeated games, even less than optimal things. So there's no guarantee when there are multiple equilibria out there. There's no guarantee that the good equilibrium is going to be the one that wins. So, you can't be optimistic. You can't be like, oh, I'm going to make a cryptocurrency, and the best thing for everybody would be if everybody valued it at $1,000, because I can show you how that would be best for the whole community. No, right? If there's a wide space of things that can occur, then you have no way to ensure a priori that people are going to find their way into the equilibrium you think they should go to. They might find their way into a medium equilibrium. They might find their way into a bad equilibrium, unless you somehow constrain where they end up. So that's going to be the rest of our story, or much of the rest of our story, which is biasing this chaos, right? So now we're in a situation we don't want to put hard floors and hard ceilings around things. We want there to be some scope for valuation to change, but we also want things to be sort of kept in some kind of a range. And if we look out in the world, we can see this game get played a lot, right? So if we look at, stock markets in the world, it's pretty hard to know, whether, I don't know, is Apple worth whatever $110 it's trading for now? But it would actually be pretty easy to know if Apple stock was worth $20, right? If you just sort of collected the dividends under almost any reasonable scenario for what might happen to Apple short of Armageddon, $20 a share, you're going to get that back. And so the insight that I think is the neat insight is that we can take our notion of redeemability as being a floor underneath of an asset price and think of what's usually referred to as fundamental value. Right? And fundamental value is this very vague phrase people use to describe financial assets. But the value of the dividends that you're going to get, the value of control rights you get, the things that are supposed to make, the value of Apple's cash in its vault that theoretically can come back to you, that you have a claim on by virtue of holding Apple shares, All of those things add to fundamental value. And one way to understand that is it's a lot like redeemability in the sense of, okay, I look at those things, the dividends I expect Apple stock to pay me, the possibility that they could distribute out all that cash they have in a vault back to me via buybacks or via special dividends or whatever. And I look at all of those benefits and I say, look, okay, I can't sell. I'm not allowed to make derivatives or strip and say, okay, I'm going to just sell you the benefits. And so that's like redeeming the stock. I can't do that. But I can evaluate those benefits. And I can say, well, if those benefits are worth $20 to me, or if they're worth, I'm sure they're worth $50. I'm sure just the cash flows from Apple stock are worth $50 to me. Well, then I would never sell a share of Apple for less than $50, right? I might not be sure they're worth $120. The actual stock price isn't going to be set at the floor of the price because lots of people think there's no way that Apple stock's not worth $50. But it rises up to what lots of people think it's probably worth at least, and it's risen up to $120 or whatever it is. But just like with redemption, you would never sell a token for $5 that you knew you could redeem for $10. You would never sell Apple stock for $20 if you were sure that the dividends you were going to get from it were worth $50 to you. Right? It's the same story as redeemability. You would never sell at less than what you're sure the value of the fringe benefits of holding the asset are to you. Right? So fundamental value, what gets referred to as fundamental value, is a lot like redeemability, but it's a little bit different from redeemability in the sense of with a redemption price, it's a fixed price. With fundamental value, we might all have different evaluations. Like I might be sure that the fringe benefits associated with holding Apple stock are worth $50 to me. You might not be so sure. You might think it's only worth $30 to you, right? And so the price in the market is going to be biased upwards by that fundamental value, but there's never going to be one price below which it will never go. Just the further down it goes beneath any plausible estimation of the value of those fringe benefits or future cash flows, the less likely it is to stay at that low valuation. It becomes a very fuzzy, squishy kind of floor. And these are the kinds of things that I think in practice we're going to want to pay a lot of attention to designing cryptographic assets for communities and decentralized organizations and crypto equity. Is we're going to want to endow them programmatically with fundamental value, with fringe benefits or benefits that come from holding the asset. And those benefits will serve to put a floor underneath the price of an asset, not a hard floor, but a fuzzy floor. I'll show you a picture of that really quickly and then come back, right? So this is the idea where before we had a hard floor at $10 because we had a redemption price. Now we have a probability distribution of price where it's really pretty improbable in this probability distribution that it's going to go below this floor because the fundamental value or fringe benefits of holding the asset are sufficiently high that it's unlikely that enough people would be willing to sell down here to bring the price down. So it's a very squishy, it's a fuzzy floor. So there are lots of potential ways that a cryptographic asset designer can endow a cryptographic asset with fundamental value, right? One is use value, right? So maybe the cryptographic token in and of itself is useful in a game I'm playing. An example of that is Ethereum, right? The main reason we are told we should buy Ether isn't because it's like Bitcoin, some speculative gold. It's because Ether has a use value if you want to run applications on the virtual computer that Ethereum is defining, the vastly distributed, trustworthy virtual computer. You need Ether because you can buy compute power. That's use value, right? Other kinds of potential benefits are like Apple stock, claims to future flows of cash or value, right? You can make a cryptographic asset that pays dividends, pays interest, depending, you can make cryptographic assets in the social media example where if your community of friends does good things, then you get some kind of payment that comes from holding your asset. Those future flows of value become a fundamental value. Claims to assets in the case of a triggering event, if you have a distributed organization, for example, distributed autonomous corporation, and it goes bankrupt, right, but there's still residual value, it ceases to function. Let's say it's not wholly bankrupt, but you decide to terminate its operations. To whom does its residual value go? To whom do its assets go? Well, if it were regular equity, they would go pro rata to all the holders of equity, right? So that's claims to asset following some trigger. Special dividend would be another example of a kind of trigger, right? So you can make a cryptographic asset for a distributed autonomous corporation where you say that if we all vote to end the corporation, then the assets held in the corporation's bank account get distributed by smart contract programmatically to all of the asset holders. Well, that adds fundamental value to the digital asset. The last three are more sort of subtle, and so in a certain sense, they're more interesting. I'm gonna do the fourth one last because it's the most clever. Control rights they exist with stock, right? When you buy Apple stock, you also have the right to vote at the stockholder meeting. But for most shareholders, that's a very trivial component of value for an ordinary publicly traded corporation. For distributed autonomous corporations, though, I think that's likely to change, right? One of the real reasons why we're interested in making distributed autonomous corporations with crypto equity is to have much more participatory structures where the decision-making by the organization is participatory. The people who are effectively the shareholders are much more actively involved in the decision-making. So if that's the case, the control rights associated with a share of crypto equity, for example, might be a significant component of value if it's very important to us, if we value the behavior of the company, right? If we care what it does. So we might be a customer shareholder, and it's important to us to be able to, ensure to some degree, or at least put our 2 cents in, that that our neighborhood is served by our distributed autonomous corporation, right? So control rights might potentially be lots more important in a distributed autonomous corporation setting than they are in a large, gigantic public corporation setting. Liquidity benefits are the only fundamental value Bitcoin has, right? So with ordinary traditional shares, Apple stock is actually very liquid, but I can't make payments with it, and I can't easily use it as collateral for loans other than margin loans for institutional and regulatory reasons. Bitcoin exists, its only fundamental value is that it makes it easy to make transfers and payments, right? So it offers liquidity value, that's its only fundamental value, right? Other kinds of cryptographic tokens, the crypto asset space is an alternative regulatory regime in which the kinds of restrictions that prevent people from using Apple stock for direct payment probably won't apply, at least for a while. So if you make a distributed autonomous corporation and you own a token of stock in that corporation, you can pay me for an apple, I mean like the fruit, for a banana, let's say a banana to not be confusing. You can pay me for a banana with a fractional share of your stock, right? So liquidity, purchasing benefits, you can probably use that against collateral in some cryptographic lending scheme. You might have liquidity benefits from any kind of cryptographic asset. Again, the prototypical example there is Bitcoin, which is its only fundamental value is liquidity benefits. The most interesting one, the one I skipped, is capacity to extinguish debts, fees, or taxes, which is an important story, a controversial story, but an important story about why traditional money is valuable. Right? One story about why traditional money is so valuable that sort of defies a lot of people's intuitions are because of things like taxes and debts. Right? People usually think that taxes and debts would make you less value participation in a community defined by exchange of a token like a dollar. But actually, if you owe somebody money, it's very unpleasant if you can't service that debt. Right? The legal system makes your life unpleasant. So you're actually pretty motivated to sell your labor or to sell your assets for cash in order to service your debts, right? The same thing, if a government is concerned that there's going to be a big inflation, that people no longer value its token very much, a government can levy taxes and say, look, we're going to put you in jail if you don't pay us back some of this money we made up, so you better work for it, or you better sell assets for it. And all of a sudden that undergirds the value of money. So that's one, it's a controversial story, but it's one widespread story for how fiat currency gets its value. It gets its value because people owe money either to governments or to other people, and the legal regime makes it unpleasant not to satisfy those debts, not to service them, and so people are motivated to provide labor or goods and services in exchange for the money that they need to avoid the unpleasant consequences of not meeting their obligations. So capacity to extinguish debts, fees, or taxes is an important benefit that can support valuation of an asset, and I think that will be used in a variety of distributed autonomous communities where people are going to levy taxes, basically, and probably the cost of failing to meet your tax obligations will be exile in the community, and people who value participation in the community will seek to get the tokens in order to be able to maintain their participation inside their virtual communities. I think that will actually be a pretty important design element for cryptographic assets. Okay, I think we've talked about most of this stuff. I want to move a little bit more quickly since it's late. The main point of this slide is to say that things are very fuzzy because these fundamental value things we're talking about, people talk about like in the real world, like stocks are overvalued or stocks are undervalued, or I've done a discounted cash flow analysis of this stock and I know what it's worth. Nobody knows what the fundamental value of a stock is worth, right? These things are really, really hard to value, and they're likely to be even harder to value in a cryptographic space where oftentimes, suppose that we have a cryptographic token that pays dividends, well, it probably pays dividends in Bitcoin. So we have a meta valuation problem. Not only do we have to value the flows that come from the asset, but if we want to value it in dollar terms, we have to take our uncertain valuation of those flows in Bitcoin and then our uncertain valuation of Bitcoin and smash them together into a doubly uncertain valuation of the cash flows. Right? So this is going to be a very squishy kind of thing. We're not all going to agree on the fundamental value, but probabilistically speaking, we're going to end up with this, where there are going to be some values that are just absurdly low and will be effectively a price floor, and then the likelihood that this chaotic Nash equilibrium space will settle on different values will increase as we go up away from that floor of fundamental value, right? So we're unlikely to be too low. As we get higher, we're less constrained by fundamental value. So we have our squishy price floor. Okay, I get to skip these slides because I've already talked through the 6 sources of fundamental value that I named. So we can, for fundamental value, for several of those, we can model them perfectly conventionally. So these equations, if you've ever had any finance, are perfect. They should be familiar. That's the general equation for discounting future cash flows. That's the equation for valuing a perpetuity of constant cash flows. This is the equation for valuing a growing perpetuity of cash flows, right? If we have a crypto asset that's going to pay Bitcoin or dollars somehow or whatever, over time we can value fundamental value in the same way analysts traditionally do. Value this stuff. But as we said, I think I'm going to go through this for lots and lots of reasons. It's going to be unusually challenging. It's very challenging to value stock, for example. Every financial asset other than simple risk-free bonds has a lot of fuzziness in its valuation in the real world, and cryptographic assets, at least for the beginning, while we get used to them before things stabilize, will be doubly hard to settle on fundamental values for. But they'll still be there. We'll still be able to put values beneath things, define a squishy floor. Okay, so we can define a floor. The question becomes, well, how can we define a ceiling, right? So one thing that sucks about an asset is you can't stop its value from going too low. That pisses off people who are holding it. When Bitcoin dropped from 1,000 to 200, people were not so happy about that. But in the scheme of things, it's equally, arguably sometimes more destructive if valuations go arbitrarily too high, right? If we want to set up a system where people are rewarded for their participation in our social network, and because of this weird sort of Nash equilibrium chaotic space where we just don't know what prices are going to end up at, there's a sudden bubble and some, crappy community of people who are just assholes have their token go up to 1 million, while, the virtuous, good contributing community has their token very low. That's valuation noise that's going to violate the incentives that we're trying to set up for our community. Further, even if all we're concerned about is valuation, even if we're just greedy, in actual fact, the greater fool games that tend to make prices go up very high, in theory, there's no constraint on them. And actually, it's an interesting question in the world now. The Fed seems to be playing a no constraint game, arguably. on financial asset prices. But in the real world, absent the intervention of a central bank with infinite funding, with infinite capital, there's the greater fool game can go on for a long time and can be reasonable to play, but it's always going to end at some point because there are financing constraints, right? When the prices go high enough, plus when people issue more tokens, right? When there are a million Webvan copycats because their tokens are so expensive, eventually people can't continue to play the game of, okay, I agree to always pay more than what you paid because you agree to always pay more than what I paid, right? That's the greater fool game. We just constantly sell to one another at higher prices, and we're all better off for a long time except for whoever happens to be in the game at the wrong time when it unpredictably ends. But it will end because at some point we can't finance the elevated prices. I can't afford to pay you, $1 million for a share of stock because I just don't have it, even though I'd like to because I think you'll pay me $1,200,000 next week, but I just can't do it, and the game dies. At that point, or it can die at arbitrary points. At some point, greater fool games collapse, and when they do collapse, they are often really harmful to the ecosystems in which they arose. Right? Look at Bitcoin now. If Bitcoin had risen steadily from 0 to 200, it would, in the mainstream press, be considered a wonderful, amazing success. The fact that it rose to 1,000 and dropped to 200, it's a has-been, wash-up, dead scheme in the mainstream press. Right? You look at what the tech bubble did to tech for a period of 5 or 6 years after it crashed. So if we're designing assets, we don't want them to have this bubbly behavior, even though it might be nice. You think to yourself, the sort of Bitcoin ethos was like, oh, let's make it a constrained asset so its price can go up, 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 and people speculate. That sounds good for a while, but for most applications, it's not really a good philosophy. You want to constrain the valuation of your asset to values that are reasonable given the role that your asset is playing in some larger system, right? So if our asset is supposed to reward people for their contributions in our social media, in our social network, then there shouldn't be arbitrary spikes because we settled into a greater fool game, and there shouldn't be collapses that make people drop out of our network because they suddenly thought they were getting rich for free and now they feel poor. Right? The asset should track what we want it to track. Well, so we can do that. We can do it with a hard ceiling. We can do it by promising to issue the asset for a price. But oftentimes we don't want to. We want there to be some play in the asset values. We don't want a hard ceiling. But we can do that in a squishy way with issuance policy, right? By algorithmically or discretionarily having some kind of way of deciding that, hey, the price of this asset is getting pretty high. The probability of our issuing new assets and selling it into the market goes up with that, right? So as a bubble begins to form, we start continually selling more assets, and that can be a stochastic algorithm that rolls the dice, and the likelihood that it's going to start selling assets increases as the price goes up above some algorithmically determined measure of fundamental value. Or it can be discretionary. We as a community say, you know what, I think our token is overvalued, so let's sell it. The important insight to notice, I think it's particularly important in reaction to some of the intuitions in the Bitcoin community that basically say issuance is always a form of debasement or inflation, is that issuing an asset while it's overvalued in a long-term sense increases the value of the token to existing asset holders. Right? So in a short-term sense, if it was going to go into a spike, existing asset holders would feel better off riding the spike. But the vast majority of existing asset holders aren't going to be able to sell right at the top of the spike. Most asset holders who are holding for any reasonable period of time don't really get the benefit of those spikes and drops. They get the drama of being a millionaire and being a pauper, but they end up a pauper. Right? So in a long-term way, the right thing to do to maximize the value of a token over time is when it is overvalued so that it is predictably going to collapse back to something closer to a reasonable estimate of fundamental value. That's your opportunity to screw somebody else. Right? You sell it at the high price. You purchase some kind of asset that's going to contribute to the fundamental value of your asset, and you're better off. You haven't debased. In fact, you've done exactly the opposite of debasing. You've enhanced the value of your token over time. Okay, so this is the fuzzy ceiling of stochastic algorithmic issuance, which is basically as the asset price rises above the fundamental value, the likelihood of your issuing increases, and as you keep selling into the buying interest in the asset, the likelihood that the price goes up and up and up gets lower and lower and lower, right? As the price goes higher and higher, I sell more and more and more. Eventually, I'm going to exhaust people's willingness to buy my asset. So I end up with a fuzzy ceiling above the price of my asset, right? Just by declaring an asset that when the price rises above what we consider a safe estimate of reasonable value, we increasingly issue. And when we issue, we have to think really hard about what we do. Yeah. So Bitcoin does have fundamental value, but it's not very stable, right? Bitcoin provides liquidity services to the people who hold and transact in it, right? So people who wanted to buy stuff on Silk Road that they couldn't buy from the local store, they were getting a service from Bitcoin that they couldn't get from other media of exchange. That's a form of fundamental value. The difficulty with Bitcoin is liquidity services is a potentially very unstable game. Just like, a nightclub can be a Nash equilibrium. Everybody goes to it because everybody goes to it this week, but then a new one opens up next week, and then all of a sudden nobody goes to it anymore. That network effect that comes from everybody using Bitcoin, nobody knows how stable it is. It could be really stable. It might not be stable. We don't know, but it is fundamental value. So I don't know that I have a strong story about the connection between Bitcoin's price and its volatility one way or another. I mean, its volatility, you'd measure it in sort of percentage terms. If it's $1, I don't think it would jump $30 in a day, but it might jump 30 cents in a day, which is, I don't have a strong story about that, but there might be things that I'm missing that I haven't thought about it very much. Bitcoin in particular, we've talked about this, has some peculiar institutional things having to do with if it's used for transmission, does its slow block time help or hurt its valuation? But I sort of want to stay away from the specifics of the Bitcoin architecture because I don't think they're very general, I don't think. Yeah?
The weird thing about liquidity as its value is that seems fairly independent of what the price is.
Well, yes and no. So at the end of one of the last slides is a balance sheet for Bitcoin, which is very speculative. But the value of, in a sense, the liquidity as a value, you're right, it doesn't matter what the price of Bitcoin is per se, but there is a boundary on how much people who hold and sell Bitcoin can extract as transaction fees, whether those transaction fees show up directly as a transaction fee or in the dilution that comes from mining, right? So mining is an issuance without purchasing a countervailing asset. So it is dilution, right? So there are costs in Bitcoin, there are costs to transactors that go to holders of Bitcoin who make Bitcoin available for liquidity. And we can value that. We can value all of those costs go to the holders of Bitcoin, and we can value the service of the liquidity that they provide by, say, comparing them to Western Union, right? We can say, okay, here's a comparable. Bitcoin mediates X dollars of transaction volume over a certain period. People would be willing to pay Western Union 10% of X for that same service. So the fundamental value of the service that's being provided there is, up to 10% of X. And then we can say, does the Bitcoin price, do those tokens in aggregate, are they within the range of 10% of X or are they not? Are they much higher? So we'll see that precisely at the end of the talk. Okay, but an important thing to note about the Bitcoin example in the context of what we're talking about now is Bitcoin is an example of a token that cannot adopt the strategy that I'm encouraging tokens to adopt, which is to say, I'm claiming that the tokens should try to bound put an upper bound on their price, and that's good for existing asset holders because you're going to use your overvalued token price to buy assets that are worth more in the long term than the token, and that's going to make existing token holders better off. It's like when tech firms, when their stocks spike and they go on a buying spree of acquisitions because it feels cheap to use their overpriced stock to buy stuff, right? That makes existing shareholders better off in the long term to use spiking share prices, spiking asset prices to make purchases while things are cheap. Bitcoin can't do it because it has no place to put an asset that becomes available that people who hold Bitcoin then have a claim on. There's just no infrastructure for that.
It's decentralized.
Oh, it's not decentralized is fine, right? So we could make a decentralized autonomous corporation where in an Ethereum contract there's an Ethereum account, and we sell our token when its price goes up, and the funds go in the Ethereum contract's account. And if we ever decide we want to liquidate our corporation, all those funds that are stuck in the account get distributed to us, right? So decentralization is no problem. We can have a decentralized organization.
How is Ethereum security?
All right, let's
yeah.
not get too far off track here.
I'm just saying it's making assumptions like you need Ether to secure Ethereum, and so
no.
has the same problems as Bitcoin in that example. So
Yeah, no, Ether does. So for the perspective of this example, I'm presuming that Ethereum does what it's built to do, which means lets one define trustworthy distributed applications. So you're right in the sense of if the layer beneath, if the security layer of Ethereum doesn't work, then anything that's trying to hold an asset on behalf of crypto equity holders, for example, those assets aren't going to be secure, because it's like if I'm Apple and I keep my funds in a bank that can't keep, in an unguaranteed bank that can't prevent bank robberies, then Apple doesn't have the asset, right? So if Ethereum's like that, then sure. But to the degree that Ethereum does what it's supposed to do, there's no problem with having a cryptographic asset that has a claim on assets, that when its price goes up, it purchases assets, right? And if it's an organization, right, the asset could be, okay, I think our price is too high, we're just going to buy cash and put it in a bank, put it in our contract and invest it, and that's going to be value productive for our token holders. If it's a more interesting organization, if we have a distributed autonomous corporation and the corporation actually does stuff in the world, it can be, hey, let's invest, let's acquire another firm, or let's hire somebody to write, new software, new infrastructure, or let's open a new branch of whatever we are, right? If we're a business, we don't have to just buy portfolio assets, we can invest in the business when our token is high. We issue into the market as our token becomes overvalued, and we use it to invest in some asset that's going to increase value for token holders. Whether that means just putting funds in a bank and investing it for interest, or whether it means expanding our enterprise, right? And using the opportunity presented by a spike in our share price to issue assets and raise funds for new investment in our enterprise. Lots of things we can do. Okay. So again, I'm going to go fast because we've talked about this. It matters very much, right? I'm arguing for this issuance into high share prices, into high token prices, to put a bound, both because it's good for the games in which the tokens are meant to function, and it's good for token holders. It's the right thing to do, but it's the right thing to do only if you do the right thing with the token, only if you buy something with the token that produces value for existing token holders. Okay. So this is a slide that's just very quickly intended to show what happens if you do this scheme. So yeah, with issuance, it kind of seems like it sucks. Why did I put a ceiling? My token price was going to spike to infinity, but I put a ceiling on it like that so that it didn't go as high as it might have gone. But because I issued overpriced assets, I gained funds and I used those funds to invest. And so my fundamental value rose, right? So what ends up happening in this game, if I play it right, is that rather than seeing a short-term share spike, I see a long-term, much smaller rise, but a more sustainable rise of my whole probability distribution of pricing, because the fundamental value of my asset has gone up. I let my ceiling track, right, so that I maintain a range of the same width. The fundamental value of my, my distributed autonomous corporation has new branches, has expanded. It's got a higher fundamental value. And so I've seen my whole probability distribution of token price rise rather than a transient, exciting spike and collapse. Okay. Last major topic talk about is that it's always a good idea to think in balance sheets. So balance sheets are a really old technology. They're really simple. They're really stupid in a way because we really need to think probabilistically about asset valuation, and balance sheets only let us set up point values. But they're really intuitive and easy for people. And for every cryptographic token in the world, you can invent a balance sheet and use it to analyze the valuation of that token, right? If there is a token and that token has value, then it is a claim against something. That something might be totally imaginary. It might be pure psychological value, right? But I can put that psychological value and call it a value and put it on the left-hand side of a balance sheet and then ask questions about whether that value is reasonable or sustainable. So I'm just going to do that as an exercise with Bitcoin and Ether. I put this big caveat. It's hard to read in this red on block, but this is just me saying, look, I'm not serious. I'm not actually doing an analysis of Bitcoin. As we talked about before, fundamental analysis of crypto assets is really hard in general, really squishy, really probabilistic. Bitcoin in particular, its one source of fundamental value is unstable liquidity provision. Really, really difficult. I haven't done a lot of research. I just looked at Blockstream.io or something and got some quick numbers and made up an example. But I don't mean I'm going to claim that my analysis says that Bitcoin is overvalued and going to fall. I don't actually have an opinion on whether Bitcoin is overvalued or undervalued or going to rise or going to fall. I have no idea. It's just an exercise. So here's the exercise. Right, what I did is I looked at a few things. I used the traditional formula of valuing a perpetuity. I looked at.
When you say you have no idea.
Yeah.
When you say you have no idea, then does it mean that you cannot calculate a fundamental value?
Well, I certainly can't calculate a fundamental value with any certainty. No, I mean that's the thing about fundamental values. There's a great Fisher Black, right, talking about the stock market. He was a big proponent of financial markets and stock markets, and he was the president of the American Finance Association for a while, and he gave this great talk called Noise. And he said, in my opinion, actually financial markets are pretty good. The stock market's pretty good, right? At almost 90% of the time, stocks are within a factor of 2 of their fundamental value, right? They're somewhere within a range of half their fundamental value and double their fundamental value. Right, and that from Fisher Black, really, renowned finance person's perspective, was a tight and efficient asset market, and that's really, I think in general with everything but the simplest financial assets in the real world, and even more so with cryptographic assets. I can tell you that Apple would be undervalued at $20, and I can tell you that it would be overvalued at $1,000, and I might be able to tighten that range up some, and I might be able to tighten it up enough that I make a bet on it, one way or another. But I will never be sure that I can compute for you, this is my estimate of a point value of Apple stock, and you should believe it.
Okay, but even when you're saying that it's undervalued at 20 and overvalued at 1,000, it's like what is going into this? And like I say, very well, if it's at 20, people are going to buy, and if it's at 1,000, people are going to sell. So it's even there. It's like what average opinion expects.
Sure, it's very conventional.
Yes.
Right, I'm going to do conventional analyses, and I'm going to say something like it would be really hard to vary the parameters of a conventional analysis in a way that would put Apple's valuation below 20. So it's very squishy, right? It's still social. There's no firm wall here, right? Except for a redemption price, we don't have a wall. But we do have, in a social sense, a squishy floor because people do use conventional.
Okay, guys, do you remember our
Okay.
question?
Okay, so we're almost done, so we can take questions in a minute because there are just a couple more slides. So anyway, so this is Bitcoin. I use the Western Union analogy, everything in red is a very questionable, probably false assumption, right? I use a Western Union analogy. Said Western Union earns 10%, which I just pulled out of my ass for how much it earns for that's sort of my experience of sending money to Romania. I very questionably said that, the only things that weren't just sort of speculative transfers within the network were things that went through the exchanges, that actual payment services go through the exchanges, because there's no way for me to easily tell what fraction of Bitcoin volume is just speculative trade back and forth and what percentage is actually funding payments or transfers. So lots of stupid assumptions here. There's no reason to take this particularly seriously, but suppose that you do, suppose that I actually, thought it through really well, and yes, with all the caveats that Flavia put forth, that's my best point estimate of the value of Bitcoin, right? I can, on the liability side of crypto assets, it's really easy. I can take the market price, multiply it by the amount outstanding, and that gives me a market cap. And that's effectively a liability of this virtual organization. It's a liability in the sense not that the organization can go out of business. It can't. It's equity. Its price varies. But it's a kind of liability in the sense of if I want to feel comfortable buying a Bitcoin, I better feel like the asset side of this balance sheet can justify that market cap, right? But I put, 1.8 billion as the asset side, and the market cap of Bitcoin currently is 3.8 billion. And so my balance sheet analysis says Bitcoin's overvalued, and I should expect it to drop by $142.23, exactly that, to 131.65. And so, so again, this is not to be taken seriously for its details. It would never be as precise as those 2 decimal places say, but if I seriously wanted to study Bitcoin, I would do this analysis, and I would do it with lots of scenario analyses. I would say, okay, well, what if my assumptions, I would vary all of these various questionable assumptions in different ways and see how that changed the balance sheets, and then I would look at my distribution of balance sheets and valuation estimates and come up with my best guesses about a range of valuation, right? There's no company for Bitcoin, but that doesn't stop you from writing up a balance sheet for it, and you can do that with any firm. Since I think Bitcoin is overvalued, the right thing for Bitcoin could do, if it had a place to store assets, would be Bitcoin should be issuing more of itself, selling Bitcoin to the world, and then using the proceeds to distribute to existing Bitcoin holders in some form. Bitcoin doesn't have the infrastructure to do that, but that would be by this analysis, if you believe it, which you shouldn't. But if you believe this analysis of overvaluation is right, Bitcoin ought to be creating new instances of itself and selling them at this overpriced price.
But then
it would change the price, but that's what we want, right? It would converge to something less like overvaluation. While it did so, it wouldn't harm existing holders, because for every time that we sell an overpriced Bitcoin, so the assumption is that in the long term, things are going to converge to something not too far into the tails of this notion of fundamental value. If that's right, we're not actually really harming ourselves by selling at this high price, because it was going to converge to that. Eventually, we're helping ourselves because we're taking advantage of the spike. Now, if you think that, sort of valuations can be unmoored forever, and they kind of can be within a large range, right? Things are very chaotic. Then you might say, no, I'd rather just take a chance on Bitcoin sort of hovering forever above any reasonable valuation. And that, for Bitcoin, that might be a reasonable approach. But if we're talking about something like the social network coin I've been describing, where we actually want the value of the coin not just to be sort of speculative and crazy, but to track certain things in order to keep the incentives right for people participating in the organization or the application, then it's doubly a reason to start issuing, right? When it's overvalued, we want to issue because we can create more value for the holders, and we want to issue because we can keep the valuation of the token aligned with the incentives that we want to create in the application. Okay, so that's an example. Ethereum, I couldn't really do much of analysis on it because, we don't have any way, it doesn't exist yet. We don't have any way to estimate how much people are willing to value its network. The thing that's interesting is that, I provided 6 different elements of fundamental value for crypto tokens. I just made those up. I'm sure you could come up with more. I'm sure you could categorize them differently, but I could look and say, okay, well, which of the 6 apply to Ethereum? Ethereum, like Bitcoin, can be used to fund payments, so there could be a liquidity effect, but it also has a use value. You can use Ether to purchase valuable distributed computational services. So those are 2 potential assets that'll be there, but unfortunately we have no way whatsoever to estimate that value now. We can estimate the right-hand side of the balance sheet, though. The effective, the asset side of the balance sheet needs to be worth $18.4 million to make people like me, who shelled out for Ether when Bitcoin was expensive, feel good, feel like, I got value for what I purchased. If that asset side turns out to be worth less than that, I should expect over time my Ether holdings to not do so well. There were 6 elements that I described for things that could become assets for cryptocurrencies, and again, that's not normative. You could make up lots more of your own. But fundamentally, whatever it is, whatever you think people are deriving value from holding your asset, from holding your token, is an asset that can be put on the left-hand side of a balance sheet. And when you're trying to decide whether a valuation of a crypto token is reasonable, you can write up a balance sheet, put the market cap of the token on the right-hand side, look at the assets, and do whatever analysis you want to do to decide whether or not those assets can sum to a value that justifies that right-hand side market cap. It's a very simple procedure. a very old-fashioned procedure, a procedure to be done with great caution because you're making point estimates of things that no one can estimate precisely. So the right thing to do is lots of scenario analysis where you try variations on your balance sheet. But nevertheless, it's an easy procedure, and it works really well for crypto tokens, even though they're not formal organizations with balance sheets that get audited and published and filed and all that stuff. A balance sheet is a thing that we invent to account for things, and it can account for whatever it is that backs a crypto token as well as it can account for a traditional company. In fact, in some respects, a lot more easily and simply because there aren't a lot of bizarre accounting standards. Okay, so now we're pretty much done. This is a conclusion. It's this recapitulation. Not so interested in Bitcoin or Ether. Much more interesting is tokens where we want valuation to create incentives that are consistent with the behavior of some distributed application or organization, right, that are going to be useful to undergird the financing or the behavior of participants inside of a game or organization or social network or whatever it is we're setting up. I think we should think of cryptoasset valuation less as an analytic topic. How do you value the cash flows, and more as a matter of design. We're fortunate to be in the moment in the world where we don't have to have a textbook full of existing financial instruments and learn the conventional techniques for valuing them. We get to make them up, and I think if we're smart, we'll make them up so that we learn how to constrain their values in ways that simultaneously leave enough play in valuation so that we can take advantage of the independent evaluations of market participants in terms of there being flexibility in pricing that provides information, but not so much flexibility in valuation that we just have sort of randomness in pricing in bubbles, that we keep some tracking of the value of assets to the applications we intend them to help undergird and maintain. Without constraints like Bitcoin, tokens are largely impossible to value, invaluable in the sense that they can't be valued, but we can sculpt the valuation space. We can use an option to issue and an option to redeem to put on a hard price ceiling and a hard price floor. We can impose soft price floors with fundamental value. We can impose soft price ceilings by issuance procedure, algorithmic issuance. Algorithmic issuance does not mean inflation or debasement in an application that's set up to be able to purchase assets or distribute the funds, the proceeds from algorithmic issuance to holders of existing assets, not debasement or inflation or anything like that. Every crypto system implicitly defines some kind of decentralized organization that we can value with a balance sheet, and with a balance sheet we can get some sense of whether or not the token is likely to be overvalued or undervalued, whether or not we ought to be considering issuing more tokens. And that's it. That's my story. Now you can ask me whatever questions you want.